TakeTwo Stock, ticker symbol TTWO. Today they announced their quarterly results and the stock went up roughly 10%. But year to date this stock is down more than 30%. So did earnings save TTWO from going down further? In this video I will show you everything you need to know about TakeTwo Stock. I will quickly show you the earnings and give you my opinion. Next to that, I will show you what TakeTwo does and I will show you my fundamental analysis to see if TTWO stock is a buy or not. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analyses every week, where I will tell you everything you need to know about the stock market. So, what does TTWO do? TakeTwo is a leading developer, publisher and marketer of interactive entertainment for consumers around the globe. They develop and publish products principally through Rockstar Games, 2K, Private Division and T2 mobile games. The products are designed for console systems and personal computers, including smartphones and tablets. TakeTwo has some major titles in their portfolio, including GTA, NBA, Red Dead Redemption and so on. Next to that, they also have some mobile games, and with the acquisition of Zynga Games, they will add a lot of the mobile games market share to the portfolio. The reason why they are focused on the mobile gaming market is because it's expected to grow in high amounts in the future. Overall, the global video game market is expected to grow at a 5% growth annual compound rate in the coming years. By 2025, the market will be around 286 billion. In this market, the mobile gaming segment is the biggest. Something I really like about TakeTwo is the pipeline of the games. The 22 to 24 pipeline includes 23 immersive core titles, 6 independent titles, 20 mobile titles, 4 mid-core titles and 9 new iterations of previously released titles. TakeTwo will also focus on introducing a new business model where subscriptions, free-to-play and standalone online titles will play a major role. This is something I really like because this will provide a more steadier revenue growth over the coming years instead of a revenue jump when a new game is released. If we check the current revenue breakdown, we see that console is the biggest platform with 75% of the current sales. PC is the second biggest platform with 17% and mobile is sitting at only 8%. With the focus on increasing mobile gaming market share, this 8% will go up in the future, of course. So I think it's a good thing they are focusing on the mobile gaming market, since this is the biggest market as we saw earlier in this video. So now that we know more about TakeTwo, it's time to check the earnings they just released. TakeTwo beats the EPS by 33 cents and revenue is up 18.5% year over year, sitting at 930 million. They beat the estimates by 45 million. Since the stock was down roughly 30% year to date, I decided to buy TTWO stock around the $110 mark a week ago. I really like this company and the strong pipeline they have. It was the perfect chance to decrease my average cost of this stock. And since it's a long-term play, I don't mind being down right now. I like it when fundamentals are getting better and the price drops. And with that being said, I think it's the perfect time to check the historical stock price. I decided to compare TakeTwo to the S&P 500, Ubisoft and Activision Blizzard. On the 5-year chart we see that the S&P 500 has beaten all stocks. TakeTwo is the closest with a 56% return, but Ubisoft is down 16% and ADV is up only 37%. The 1-year chart is even more painful. TakeTwo is down 34% while the S&P 500 is down 4%. Ubisoft is down 30% and ADV is down 16%. On the 1 month chart, TTWO is down 20%. The S&P 500 is down 9%. Ubisoft 15% and ADV is nearly flat at minus 1%. So you easily beaten all these stocks with owning a simple S&P 500 ETF. But that doesn't have to mean anything for the future. Earlier in this video we saw that TakeTwo has a lot of titles in the pipeline, which will help to boost the revenue and in the end the stock price, of course. Let's check if Take-Two is a buy at current valuation. Take-Two is a 12 billion market cap company with a PE ratio of 23. The forward PE ratio is sitting at 16.8, which is very low for a fast-growing company, especially since it's expected that the gaming market will only grow from here. And with the stock price going down a lot in the past months, the PE ratio did go down as well, making Take-Two more and more attractive. When I first bought this stock, I paid a premium because I really believe in this company. Right now, based on the PE ratio, you pay a small premium. And based on the forward PE ratio, you are buying a potential undervalued stock. Next up are the margins. Right now, Take-Two has an operating margin of 21% and a profit margin of 15.4%. Both are fine in my opinion, since they are above the 10% mark, which is my minimum. In the past couple of years, the margins have increased quite a lot, which is a really good thing in my opinion. In the last couple of quarters, margins have decreased again. So this is something you want to keep an eye on. Return on assets is sitting at 7%, which is too low. You want this number to be above 10%. Return on equity is sitting at 15%, which is great. The 12 trading month return on invested capital is sitting at a minus 0.4%, which is not a good thing. But the 5-year return on invested capital is sitting at 13%, which is above the 10% minimum. So you also want to keep an eye on the current ROIC. The 12 trailing month revenue is sitting at 3.4 billion, and they have a 4.9% quarterly revenue growth year over year. This is before today's earnings. If we check the revenue growth over the past years, we see that it's up quite a lot. The boost in 2013 and 2014 is caused by the release of GTA 5. When we check the balance sheet, we see that Take-Two has a 2.5 billion in cash, and debt is sitting at only 244 million. This means they can pay off all their debt very easily. They have plenty of cash left to do all other things, such as buy back shares, do acquisitions, research and development, and so on. So for me, it's very important that free cash flow is growing. In this chart, we see that free cash flow is up a lot. Again, the boost in 2014 is caused by the release of GTA 5. Since then, the free cash flow went up quite nice and steady. In 2020, it went down because of the Roni virus, but after that, the free cash flow is up again. So this comforts me a lot, especially since they can pay off their debt very easily and they have enough cash to do acquisitions, which is very important to me for these type of companies. A thing that I don't like so much are the shares outstanding. Since 2018, it's not so bad as earlier in the days, but still, Take-Two does issue more shares, meaning your share becomes less valuable each time they do so. So this is one of the negative things about this stock. With the free cash flow at a healthy level and the debt at a really low level, I would love to see some share buyback program, or at least no more shares issued. The last thing I want you to show are the fundamentals of the competitors versus TTWO. I decided to include Ubisoft, Activision Blizzard and EA. The first thing that catches the eye is that Activision Blizzard and EA are both way bigger in terms of market cap. When checking the valuation, we see that TTWO has the lowest PE ratio, which is a good thing. The revenue growth year over year is the highest at EA. But Ubisoft and ADV have a negative revenue growth year over year. TTWO is sitting at almost 4%. But since all companies are depending on gaming release titles, I think it's better to look at the 3 and maybe even 5-year growth rate. And we see that TTWO has the highest versus the competitors, so again, TTWO is the winner here. It's the same story with the net income compound annual growth rate. Take-Two has the highest. With the levered free cash flow 3-year compound annual growth rate, EA and Take-Two have the highest number again. When we check profitability, we see that ADV has the highest margin, but TTWO has the second highest margin. Return on equity, return on assets and return on total capital is the highest at TTWO. So for me, Take-Two is the winner here. My final conclusion is that Take-Two is a great company with a big pipeline which will bring in a lot of revenue in the future. At current valuations, TTWO is a buy for me because of the future-proof business and because of the increasing quality of the fundamentals. Right now, there are only 2 things that I really don't like about this company. The first one is the shares outstanding, and the second one is the return on invested capital 12 trailing months. So I hope the company will do a better job in the future at these two things. Other than that, I think TakeTwo Stock is a buy right now. Most recently, I bought some extra shares, and with today's earnings, I feel more and more confident about this stock. I hope the stock will go down even more, so I can buy at lower prices. For now, I will slowly keep adding shares to increase my position. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor, and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching, and I will see you in my next video.